And welcome. This is Mary Ellen McGonigal with your Friday afternoon MEM Edge show. And this is the show where we bring you where the action is in the broader markets. Of course, this week, the action was quite negative. We will, of course, cover that, take a look closely at the broader markets, see where we closed for the week, and then beyond what is shaping up by way of sector rotation or not. And also, I do want to share with you some of that news items that drove price action last week, and it was all about the Federal Reserve. So Monday and Tuesday, the markets were relatively flat, and into Wednesday, all eyes on Fed Chair Powell as comments were released following news that they were keeping interest rates the same. So that pause was not unexpected. That was fine. It was everything to do with Powell's more hawkish tone. In other words, the concept of not just one more rise potentially in the interest rate level, that again was anticipated, but it was talk that the currently elevated interest rate scenario could remain in place. They are very, very in tune to getting that inflation level down to 2%. And inflation has been sticky. I'm going to share a chart with you that talks about, in particular, that consumer price index and the impact that this increase in interest rates in inflation actually has had on the markets. So that was certainly the most impactful news item last week. We did see the markets respond very swiftly and in a negative manner. Also, we did get housing data last week. Housing starts did drop 18% in August. We also got news that builder confidence fell to a 5-month low. This is all about that rise in interest rate, also pushing mortgages up over 8%. So that was one area that had been holding in well, and we are seeing weakness there. As the week progressed, and certainly today on Friday, there were several Federal Reserve governors that were speaking at various events, and the comments were very much in line with Fed Chair Powell in the sense that they do see an elevated interest rate scenario as being in place for some time. And two of the governors did, in fact, see more rate hikes as being positive, more by way of contributing to the weakness that's in the markets this week. Now, next week, we get very impactful inflation data. In fact, it is the most closely watched data. It's the core personal consumption expenditure data, PCE. It will come out next Friday. So that is going to be very front and center as it relates to how the Fed may respond should we see a continued uptick. Now, the uptick hasn't been high, but it's certainly not going in the right direction. We also get consumer sentiment next week, durable goods orders, and Q2 GDP number is going to be revised. So that's what's on the lookout and on deck for next week. So from here, let's go ahead and take a look at those broader markets and see where did we close for the week. And here we are. This is a daily price chart of the S&P 500. And what we are looking at is key areas of support, in particular with the S&P 500. That 4,300 level is now being quoted more often, but it is one of the more widely viewed key areas that we want the broader markets to not close below. It's one of those psychological levels, similar to the break last week below that 50-day simple moving average. So keeping an eye on that 5,300 level and seeing if we are able to hold support. If not, we will need to begin looking at prior lows for potential support. So from here, let's also take a look at these momentum indicators, that RSI dipping further into negative territory, and then likewise with the stochastic. So we do have a rather negative overview, certainly for these broader markets. And last week's selling, the volume was a bit elevated, indicating distribution. And I will go ahead and share with you another view of the S&P 500. And this is what is called a head and shoulders formation where the stock hits a near-term high, pulls back, rallies, pulls back from that new high, and then forms a second shoulder. What you're on the lookout for is a potential break below the lows. And we did see that on Thursday, indicating that this negative head and shoulders formation had in fact completed its formation. Now, it's not certainly giving us a confident sense, but it is something negative relative to price action that you want to be aware of. Now, let's go ahead and take a look at the Nasdaq. Tech heavy Nasdaq was down 3.6%, and that's relative to the S&P, which was down 3% for the week. So here we are with a daily price chart of the Nasdaq composite. And again, you want to be aware of this key area of support. This is underlying the lows that where the markets closed going back to last month. And you can see how it aligns very clearly with that low period in the beginning, mid part of June. And unfortunately, we have closed below that key level. So of note also is that we do have negative RSI and a negative stochastics. Now, if you want, we can go ahead. In fact, I will share with you a weekly view of the S&P 500 because you want to have a good sense of the intermediate term outlook for the broader markets. Near term, certainly weakness abounds. On the weekly, we can see that this RSI has dipped into negative territory, and that is not what we want to see. We have seen what I can only term as head fake going back to the Q1 of this year, and we were able to recover. However, if we do go back historically and see if we do see that RSI continue to deteriorate, historically it can lead to a more prolonged pullback, and that's something, of course, my MEM's Edge subscribers will be kept very in tune to. Now, from here, I did have another view of the S&P 500, and we can take a look because what I've done is marked up what the price action was in this broader market index relative to inflation data. So if we take us back to this April into June period, we can see that during this time, this consolidation period, that the consumer price index, one of three inflation data points, it did post its smallest monthly increase since 2001. So generally well received. And from there, we did see the markets advance. We did get the next monthly CPI data, and it did show a decline, which in turn, during these two periods of declining CPI, the S&P really advanced quite nicely June into August. Now, as we see the markets pull back, we did get a data point here in the beginning of August with CPI ticking higher. And there we are with that pullback. The markets were able to overcome that. But then here, more recently, a week and a half ago, we did see CPI tick again higher. And from here, of course, interest rates elevated, and that's negative pullback there. And what I was highlighting here also was this back and fill formation. As the markets were consolidating, we were in a very similar position here for about 4 weeks. And then, unfortunately, as opposed to being resolved to the upside with inflation declining, we are seeing a pullback and even more a new downtrend in response to higher inflation. So let's go ahead and move on from here because we want to take a look beneath the market's surface, take a look at these 11 sectors in the S&P 500 2-month daily price chart view. I've added an RSI, that relative strength indicator, and we can see up here at the forefront these sectors. And it's not just a 1-week performance, it's going to be longer, but it is giving you a very good sense of where the relative outperformance is taking place. So first up here, as has been the case over the last few weeks, energy up here. However, it was down in line with the S&P 500, down 3%. It did pullback, there are some bright spots that I am going to share with you among these energy names. And I'll also share with you why as we move through, but it does remain up here at the forefront above its 50-day simple moving average. Unfortunately, at this time, it is the only sector that is above that key moving average. So as we move through, utilities up here at the forefront, down less than the markets, 2.5%, but certainly not an area that you want to be piling into. We had this sharp V-shaped recovery attempt that has pulled back. Also up here, this is going to be communication services. And a lot of the strength here was really about Meta platform and Alphabet. And Meta is still holding in quite well, but Alphabet was down 5% this week. And we can see what that did to the overall group. XLC is now down below each of these key moving averages with negative momentum. So moving through, I won't go through each one, but I certainly want you to be aware of where this most by way of weakness took place this week. This is XLY, consumer discretionary, down 6.3%. Tesla, of course, a big contributor there, down almost 11%. Amazon had a very tough week, down 8%. But I will tell you, there are other areas of weakness among this consumer discretionary area as talk of potential recession is beginning to bubble up again. And as we move through, other areas to be aware of are the fact that staples also relatively outperformed, down 2.6%, but again, very much in a confirmed downtrend, and rally attempts are being met with resistance. So overall, you can get a sense of beyond the bigger picture that these indices are showing us that the sector is really weak. So from here, we're going to take a look at some ETFs that I review each and every week, being very, very helpful by way of really fine tuning beyond that sector view and drilling down even further. So again, RSI 2-month daily price chart view. And let's take a look at what's up here at the forefront. Unfortunately, it is the US dollar. This is UUP, that dollar index, and you can see it's continuing to climb higher. This is generally a negative for the broader markets. And also up here at the forefront, take a look. Brent crude oil, and it did get up almost to $95 per barrel before settling at 92. Very, very elevated. However, this high oil price is not translating over to those energy stocks. And I did share that view with you earlier, but of note. And also, let's go ahead back and take a look at this, because this is a comment that Fed Chair Powell made on Wednesday, was the fact that this elevated price of oil, which as we all know, is being transferred over to the high price of gas. And that in turn is a big concern as it relates to inflation remaining high. So also up here at the forefront, not what we want to see, but here we are with interest rates. And here's that gap up on the yield on the 10-year, which now stands at about 4.4%. Of course, higher interest rates, negative for the markets and certainly for growth names. Also rising this week, and not really what we want to see, is the volatility index. This is the VIX, and we can see this elevation that took place Wednesday and then most pronounced on Thursday after those meeting notes. So we're now standing at about 17, and anything above 16 as a general rule of thumb is negative for the markets. This is also, of course, known as the fear index, but we can go back historically and note that periods of rising volatility can be negative for the markets. So let's go ahead and move through. Gold holding in relatively well. The overall group you can see is bouncing around in a very tight trading range. It was flat last week. And then as we move through, I do want to share with you some of these areas that had been holding in well. This is software IGV. The group was down over 3%. And we can see now that MACD is in negative territory. And ideally, what we want to do from here, and it's certainly what I will be doing with my work, is keeping an eye out for a potential downtrend reversal and using historical precedent as your guide. And I'll give you a quick lead on that from here, because we did have that very sharp pullback in these growth names and in particular software back here July into August. Let's take a look at those characteristics that marked the reversal of that downtrend. First up was a move of IGV back above this 50-day simple moving average. And then we had that black line up through the red MACD crossover, signaling a new uptrend. Marry that with that RSI. And we did have that nice downtrend reversal, unfortunately, rather short-lived given the inflation and interest rate backdrop. Now, let's go ahead and move through and take a look at some of these other sub-industry groupings. Semiconductors still experiencing weakness, down 3.1%. in a confirmed uptrend. We did see a bit of a bounce today. We will need to see certainly more before we can even begin to consider a potential reversal at this time. Very, very weak, which is, of course, leading to that weakness in the technology area. And moving through, I did want to share also with you the fact that the small cap stocks just cannot catch a break. Down 3.8%, breaking below their 200-day simple moving average, quite high on the volume front. Small caps fare well when the economic outlook for the markets is, or certainly for the economy, is strong. So another statement that these recession fears are continuing to bubble up. One area that did outperform relatively is the Dow Jones, certainly not the healthiest of looking indexes, but it was down a little less than 2%, so relative to its peers. And we're going to take a look at some of the better performers in that Dow index, just to give you a sense of where that relative outperformance is taking place. Now, from here, I do want to, actually, we can just go ahead and cycle right into those Dow names. And what I've done here of those 30 stocks is, again, 2-month daily price chart view with that RSI indicator here, descending order. And we can take a look at some of these names because this will segue into another segment, an area that I want to share with you. Well, first of all, we can take a look at UNH, this downtrend reversal, potentially shaping up. The MACD now in positive territory. Nice high volume on that rally as it's poised for a base breakout. I did want to share with you Amgen, and this particular stock did experience a cup with handle base breakout last week. And you can see this nice MACD crossover, really just ignoring what's shaping up elsewhere in the markets and holding in. I'll expand on this further, but when looking at stocks, I do have a list of the top 10 performers during the 2008 recession, and Amgen was one of those names. So let's go ahead and move forward. I want to share with you, it's not quite ready for prime time, but this is TRV, the Travelers Corp, and it is an insurance company, and it's an area that I did talk about last week, in the sense that as interest rates rise, oftentimes these insurance companies are putting their premiums to work at higher interest rates. So good news there. Chevron really holding in relatively well among these energy names, CVX, and it is continuing to hold in well. And IBM had that gap up this week, pulling back very orderly to this 21-day simple moving average, one of the dividend aristocrats. I believe it's at 4.5% on the yield, and its momentum in positive territory. So really not much holding the markets higher. Walmart is holding in, pulling back only to its 21-day simple moving average, in line with that recessionary concept where these discount retailers that are doing it right are faring well. From there, it does deteriorate a bit. Caterpillar generally holding in, but those are the highlights for the Dow. So let's go ahead, and from here, I do want to share with you the concept of, should you buy the pullback? Now, of course, your first look is going to be the broader markets. You will want to see the broader markets exhibiting strength before buying on the pullback. But I did want to share with you some of these names. This is TJX, another discount retailer, that is pulling back very orderly to its 50-day simple moving average. And we can see that this momentum with that RSI now in negative territory. But here again, you want to be aware of what a downtrend reversal, the appearance, and more importantly, the signals, so that when the markets do turn, you can have that confidence to get into the stock. Now, of course, you will want to see continued positive momentum in its growth prospects. And here we are with TJX gap up, very strong earnings, and viewed as a name and a company that is definitely on the growth path. But let's take a look at that downtrend or pullback reversal. Again, same dynamics. We have that MACD crossover moving into positive territory, and then a move back above its shorter term moving averages, get that momentum RSI back into positive territory. Another name that's really been deteriorating for some time now among these mega cap names, and that is Netflix. And what we can see here is a pretty dramatic pullback, but we have seen that with Netflix in the past. It's been quite volatile this year by way of subscribership really thinning, the company coming out and banning sharing. That gave it some power to the upside. But let's take a look at this pullback here. Super high volume. And this is something you want to be aware of if you are really tuning into individual holdings and you are thinking that they may be headed lower. Let's take a look at this move here as it relates to the gap below these key moving averages, which in turn push that RSI negative. But really important here is this big uptick here in the volume, indicating distribution. And we did have that MACD enter negative territory, which preceded further downside. But at this point, really talking about when these names get into an oversold position, that RSI gets down below 30, that's when you can begin to potentially be on the lookout for a reversal, again, using historical precedents as your guide. And another last name up here that has been, and it pulled back, it has been exhibiting maybe reversal tendencies, but not ready for prime time. And this is Intuitive Surgical, this big gap up on earnings into a nice uptrend. This is one of the names that was on my MEM edge list. We did remove it as it began to deteriorate here. And we can see that it is at this time finding support at this 200-day simple moving average. However, recent rally attempts have been denied. You will, in essence, want to see those momentum indicators get back into positive territory. We can go back to this March period as an ideal example. Once we get up above these moving averages, get that MACD into positive territory, you can see that nice uptrend that took place. So really just informing you of what to be on the lookout for, and by way of the markets potentially coming back into favor. And I did want to share with you within energy, we talked about energy stocks overall, really not following the move that the price of oil has had, but there is one sub-industry group within energy, and that is the MLPs. These are stocks that are going to be less volatile. Here we are with Magellan Midstream Partners. I'm going to pull up this full quote so that we can get the full picture here. You can see the nice uptrend, a nice continuation rally, and the stock offers a nice 6% yield. And the reason they're less volatile is because they are involved mostly in shipping and or storage, and that those type of activities within the energy space are not going to be as dependent on the price of oil. They're going to be longer term as far as being their services being secured. So we can see MMP, it's an LP in a nice confirmed uptrend, nice positive momentum. And in essence, many of these stocks are giving very nice yields, and that is attractive in this currently volatile period. This is Enterprise Products Partners, EPD, 7% yielder, and very similar in the sense that it is in a confirmed uptrend. We can see this nice downtrend reversal here on that MACD. And one last name, the other factor with these MLPs and LPs is that by and large, they are trading at very low multiples. Most part, the names I'm sharing with you now are trading at about 11 times trailing 4-quarter. Here we are with Plains All American Pipeline, PAA, and it's a 6.5% yielder. Definitely, you would be chasing it if you were to look at the potentially purchase or enter the stock at this point, but we are still pretty new with that MACD crossover pointing to potential further upside. Let's take a look at a couple of shipping stocks in this energy space. This is Frontline, FRO, pulling back from a base breakout, but a 14% yield. And we can see that MACD crossover just indicating potential further upside. I'm going to go ahead and add a 5-day simple moving average when the stock gets going. It can be a very good guide as far as an entry point potential. Another shipping name that we can take a look at, LPG. I don't believe they have a yield. Actually, they do, almost 10%, 9.8. And we can see this nice daily price chart here. This is a cup with handle base breakout that took place today, and the stock is in a very nice confirmed uptrend. So from here, I did want to spend a few minutes and talk about this defensive recessionary concept. We talked about Amgen, a couple of other names that were top performers during the 2008 recession is H&R Block, HRB, and the stock came out with very strong, actually the numbers were good. What was really getting investors interested with HRB is their staff reduction and other cost-cutting measures that they've taken that really improved their bottom line. This is another yielder, 2.8%. You can see this consolidation period after that gap up on earnings into an uptrend. You really wouldn't know what was taking place elsewhere in the markets. One last name that was in that top 10 for '08 was Vertex, and it's actually pulling back a little bit this week, but this is a top biotechnology company, very much involved in cystic fibrosis, and more importantly, the ability for their systems and drugs to actually really modify the DNA so that you can find those drugs more responsive, in this case, cystic fibrosis. So that was something I did want to share. And then last up, Costco, we can take a look at that. This particular company holding in fairly well with positive momentum indicators, certainly quite a bit different than Target that really continues to deteriorate down another. Take a look on that weekly, down almost 8.5% for the week. The company really is just not getting out of its own way, a very lengthy confirmed uptrend. Now, with our remaining time, I'm just going to share with you what to be on the lookout for, or ways that you can generate a watch list so that when the markets do get back into an uptrend, a bullish cycle, growth in particular comes back into play, you really want to be on alert for names that are holding in well, that are in this case, Akamai is a software stock, so it's in that growth space, and take a look. It's really holding in remarkably well, had a base breakout and is holding that breakout and continuing to trend higher in a nice uptrend. Another software stock that is on my watch list is Fair Isaac, and it really is mostly flat for the last 4 weeks. But if you compare that to its industry group, and you'll see that quite clearly it is an outperformer. The concept here is that once those market pressures lift and that group comes back into favor, those stocks that are holding in the best historically will go on to outperform. This is Synopsys SNPS. Not quite as strong. It has broken below this 50-day, but certainly relative to its peers. And then from here, we'll pivot in and take a look at some of these software security stocks. Okay, this is CyberArk, and we can see it did have a sharp pullback yesterday and then recovered some of that today. So still on my watch list, but not quite as interesting given the price dynamics over the last 2 days. And then last up here is another software security stock, QLYS. And again, nice orderly pullback and trending higher, all while its momentum here with that RSI is continuing to trade higher. And that's it for this week. Everyone have a fantastic weekend. If you haven't already, click that button below if you like what you've seen. Also, take a trial of my MEM Edge report. You're really going to want to keep on top of these markets, be aware of when we turn positive, where the strength is, and the best way to participate. See you here next Friday.